Surviving losses in zero DT. Thursday is the day we do the zero DT stuff. Surviving losses in zero DT options. So Jacob and the team put this together. The extreme liquidity of zero DT option markets provides attentive traders with fresh opportunities. But this high-speed trading style can be hard to stick with if you get a string of losers. And I'm going to be totally fair with you. We don't trade a lot of the zero DTs because we don't like the odds as much as, like, I like making a stock beat us. That was like, for example, NVIDIA yesterday.
Yep.
Hey, you go ahead, try to beat me, NVIDIA.
Sure.
But it's a little bit different when
this is what we did for a lifetime. And if you weren't sitting
with Edge.
But if you weren't sitting at the desk and doing a show and talking every day and watching the market,
I would trade more zero DTs.
You would trade a lot more zero days.
Yeah.
It has your.
To be fair, for 20 years of my life, we didn't have zeros, but I waited for the day that we had zeros.
Right.
In other words, expiration Friday was a zero.
Yep.
And that was the day, my favorite day.
I made my monthly nut on expiration day. That was my goal.
And there's no way to know if now is a lucky time to get started. One, controlling position size and defining risk is the only foolproof way to ensure survival. Here's the question. Can capturing profits help to control our exposure to clusters of losses as we look to sell zero DT premium every day or consistently? The whole challenge with trading is sometimes you get hot and everything goes your way, and sometimes you get cold and everything goes against you.
Yep.
And so you got to survive. It's all about survival.
Yep.
Just shy of 2 years of data in the zeros, we sold strangles. Every market open. The key here is market open. 50 delta straddles to 20 delta strangles, paired with managing winners at a variety of profit targets, 15 to 50% of the initial credit, and all trades were assumed to exercise at the mid-price. That just means execute at mid-price. Here's where it gets into a little bit of the nitty-gritty. For each date in the data set, we found the furthest into the red that a zero DT trader who began trading mechanically on that day ever reached. So they're basically start to worst. That is how much initial capital, in addition to the necessary buying power to place a trade, would have been required so that they would not have been wiped out. Okay? That makes sense?
Yep.
Start to worst. We asked for what percentage of starting days was the first win enough that they were never in the red? How much was required for an average trader starting to survive, the mean across all the starting days? And how much was required for those starting on the unluckiest 5% of all days? How much was required? Okay?
Okay.
So what percent of starting days was a first win enough, take you all the way through, and how much was required to survive? Let's take a look. Obviously, it's going to
get buying power here, adding.
How much money was required?
Yep.
Let's go to the first slide. So these are straddles. Now, we don't really sell straddles, and we like to use that 25% profit target. 15, you could use the straddles. 15 to 25% with straddles. We would never go beyond 15 to 25%. And
our research would suggest that that's where you should probably hang your hat. 50% is more for 45 days and beyond kind of thing.
So the number of times that you never, ever took any heat because you started right out of the chute, 13% at 25% target, 27% of the time on a 15% target. Okay. Now, your mean, that's your start to worst. Those numbers are not too bad. Like, how much money would you need to survive? 3,700 if you're doing it at 15%. This is 2 years worth of data. 5,600 at 25%. That's like your worst case. Worst start to worst. Your CVAR, which is the worst 5% of all cases, just so you know how bad it could get, 12,000 to 14,000. You do not want to be at the no management 88,000. That's for sure. You don't actually want to be anywhere else on this slide if you're doing straddles.
That's true.
Now, you can see the numbers are going to change. Let's go to the next slide, Beth. As we start doing strangles. Now, we don't usually do straddles or...
Before you get to this, look at the never negative frequency when you're managing at 15% compared to no management or 50%.
Yeah.
Those are big numbers.
We target between 15 and 25%. Here, it's 27 and 24. So the numbers got a little stronger,
you're managing winners, you know what I mean? Yeah. Like, you're taking some profits. You're not going to get that advantage when you...
CVAR dropped. Now, again, if you do the 40 delta strangles, your CVAR dropped. Your mean start to worst dropped a lot, only 3,300 now. And your never negative frequency actually went up. But we don't really do 40 delta strangles. So if you go to the next slide, Beth, this is where it gets more into our territory, like around 30 delta strangles. Now, the funny thing about 30 delta strangles are, this is where we live. And this is where the 25% target took over. It has a better mean start to worst. It has a better negative never frequency, and it has a lower CVAR. So once you get into the strangle area that we like to trade in, you're really looking at somewhere between 15 and 25%, but 25% becomes kind of your sweet spot. And if you go to the next slide, which is the 20 delta strangles, this is where the 25% really shines, because you have the lowest CVAR, the lowest mean start to worst, and the highest never negative frequency. So we're kind of between that 20 and 30 delta strangle, and 28% of the time, never in the red. Mean start to worst, 2,400, totally acceptable given the risk and everything else. And the CVAR 10,000 hasn't changed that much. You definitely need management. You definitely need aggressive management. And that really is the key to zero DTE trades. Aggressive management, 20 to 30 delta strangles, aggressive management, put the positions on at the opening, and then get out, move on. So some of the takeaways, and this will be right along the lines of what we just said. Repeated unmanaged zero DTE trading involves exposure to a level of risk most would find unacceptable. If it was unmanaged, 100% agree. You cannot set it and forget it. Meanwhile, stop losses are the most obvious form of management to control downsides. Capturing winners helped persistent traders by reducing exposure to serial losses. We're really talking, I don't think we're talking about hard stops. I think we're talking about mental stops, but you can do it any way you want. The closer to the money we look to sell zero DT strangles, the more effective and important aggressive profit taking was. We presented that on the 20 and 30 delta for sure. And these results were specific to strangles sold at market opening. If you choose to pair the extreme liquidity of zero DT markets with a directional assumption or some other option strategy, make sure to stay active, attentive, and most importantly, small.
You're really talking about keeping your size in check here, and you're really talking about managing your winners here. This is something we've talked about a lot.